We're ready?
Yes.
Okay.
You see the PowerPoint?
Yep, I see it. Thank you. Welcome to Financial Management. By taking this class, you are taking an important step toward building a better business. Good morning, good afternoon, good evening. My name is Leah Crawford. I am the owner of Crawford Management Group. We are a bookkeeping, accounting, tax service located in downtown Las Vegas. I am honored to present this information to you on behalf of the Urban Chamber of Commerce about financial management for a small business. Next slide. We have a very, very full agenda today. We will not have time to cover everything, but fortunately, you have a participation guide and it is very detailed. We encourage you to read it in your own time. Next slide. Today, we will explain the concept of financial management and why it is important to a small business owner. Identify financial management practices, rules, and tools commonly available to small business owners. Explain how financial management practices and rules and tools work. And we will explain management basics for small businesses, including startup financing, financing for growing your business, financing working capital, and financing fixed assets. Next slide. Next slide. What do you know or what do you want to learn about financial management? I will ask that you pause this video and just jot that down. What do you know? What do you want to learn? You can also go to page 4 and take our before the training quiz. I would pause the video and I would do that because you want to know what you want to get out of this. So you can make sure that at least time is well spent and you can get what you want to get out of this class. We'll take a few minutes for that. Next slide. The benefits of financial management. Quality financial management offers many benefits to you as a business owner. Financial management includes bookkeeping, projections, financial statements, and financing, which forms the foundation for reaching your goals through sound business decisions. Financial management is one of our main avenues to success as a business owner. Financial management is the way you know if you make a profit. Financial management helps you decide what you can afford in terms of store or office locations, inventory purchases, employees, and equipment. You need sound financial information to set your prices and select your vendors. Financial management gives you the tools to plan for overall business growth or diversification of your product lines or for reaching new customers. Financial management helps you decide which products and services and markets are profitable. Effective financial management gives you tools to chart your course into the future, adjust your direction when needed, and help you find your way through challenging times. If your business growth requires financing, loans, financial management provides the information to know how much you can afford for your business. Financial management gives you not only the documentation needed for a loan application, but also helps you discuss your business circumstance with the lender in terms of, to discuss your business circumstances with a lender in terms that improve your ability to qualify for a loan. Financial management is crucial for small business owners because financial management is a tool that you can use to determine how successful you are. Next slide. Budgeting. Budgeting. Creating a budget is the first place to start with financial management practice. A budget is a list of all of your monthly or yearly expenses organized by categories. A budget is a tool that helps you track all your business expenses, plan for the future, economize when you need to, plan for expansion, and make a profit. Next slide. Once you create a budget, use it to compare what you have budgeted for with your actual expenditures, okay? Please turn to page 8. So page 8 of your guide, we have a sample budget for you to review. I'll give you a second. Turn to page 8. Take a minute to record guesstimate amounts for what you are now paying each month for business expenses, such as rent, utilities, telephone, internet, and so on. How do you currently keep track of your monthly expenses? For those of you who are already doing this, how does budget tracking help you with business decisions? I can talk about me. I budget. And I budget because I need to see exactly what's going on. I know how much my rent is every year. I estimate how much utilities are because depending on what utilities you pay in your office space, you can guess how much you're going to pay on an annual basis. I budget for my softwares, the softwares I have to use. I budget for my payroll. Payroll is huge. I budget for payroll because based off of our volume, I know how much I can pay my employees. I also budget for, with payroll, the employer taxes. So just to make sure that when I'm budgeting for an employee, if I'm paying you, let's say $15 an hour, I'm actually paying you more like $18 an hour because $3 of that is going to my employer taxes. Very important to budget so you know what you can afford. Next slide. Bookkeeping. So bookkeeping works hand in hand with budgeting. The budget this is what I think is going to happen in the next year. Bookkeeping is what actually happened, okay? So bookkeeping is the organized process of tracking all income and expense transactions. Bookkeeping is a critical component of financial management, which leads to better business decisions regarding finances, taxes, owner draws, and requirements. Now, depending on how your business is set up will determine how the owner is paid, and there are multiple ways. But we'll stay with a Schedule C corporation to start, a sole proprietor, because they get owner draws when they pull money out. Next slide. Bookkeeping steps. We're going to take this 10 steps. We're going to talk. I'm going to tell you what it is, and then we're going to just elaborate on it a little bit. Number 1, you want to obtain a business accounting software. There are a lot of softwares out there right now. I use QuickBooks. I've used MIP. I've used Peachtree. I think there's FreshBooks, a few other tracking softwares. You want to get a software. You do not want to keep track of this manually. Number 2, you want to open up a separate bank account. Build the relationship. Banking relationships are very, very important, especially as a small business owner. I like small business banks. We are in Nevada. I like Bank of Nevada. I like Nevada State Bank. Also, if you're a member of a credit union, they also have, they do business banking. So if you're a member of a credit union, talk to a customer service rep or a manager at the credit union. You want to open up a separate business checking account for your business. Reconcile your checking account. This is probably one of the most crucial steps that I see a lot of people miss. Reconcile your checking account every month, because not only do you daily want to look at on your app, because I have my phone here, I look at my bank accounts every day to see what money was deposited, what checks actually cleared. Not that I don't use it as a way to manage it, but just a way so I can make sure, number 1, there's no fraud on my account, and that's on a daily basis. I reconcile every month. I see the expenses again, so I can see what am I spending money on? What am I spending money on? Reconciliations, very important for every bank account that your business have, and you can also do this personally. Tracking sales. you want to track your sales, right? You want to know, number one, how much did I sell this month? What is my gross revenue? What are my sales? You want to track it. So you want to use this accounting software or bookkeeping software to track your sales. Deposit all sales. Using duplicated deposit slips and deposit all sales into your checking account. Also, you can do remote deposits. You can deposit through ATM machines. Of course, when you run credit cards, you want to make sure that those credit card deposits are going into your bank account. You want to make sure that all your sales are going into your account. So now you're tracking the sales on one end, but then you're depositing the money once you make the sale into the bank so that you can reconcile it at the end of the month. Next slide. They say write business checks for all business expenses. Well, right now we also have a few other things that we can do, because you can have Zelle with your business. You can have Venmo attached to your business to pay expenses. But whatever you are using, make sure that you can track it and monitor to make sure that the funds were actually withdrawn from that account. So you want to be mindful. You want to be mindful of what you're doing and how you're doing it. So if your best practices, best practices, write checks. Write a check, send it out, check clears. But a lot of times now, a lot of people are using ACH transactions. That is also okay, but make sure you can track it so that you can keep track of what you're spending money on in your business. Obtain a separate business credit card. Now, obtaining a separate business credit card, you just want to make sure that you're not mixing your business expenses with your personal expenses, because you want to be able to monitor how well your business is doing. And one way you're doing it is seeing how much money is it costing you to generate these sales. Pay business expenses first. Most businesses start out as a sole proprietorship. And sole proprietorships, you, the owner, do not get a salary, rather you take an owner's draw. And that is what most people do. Schedule C, sole proprietor, you pull money out of it, it is an owner draw. You do not deduct that from your business expenses, because it's you, the owner, getting paid for the business, for your work that you're doing in the business. Rule of thumb: sales pay for business expenses first, personal expenses second. Remember that. Sales pay for business expenses first, personal expenses second. So if you are a business owner, you are generating $10,000 in sales, we'll use an even number. Your business expenses are $4,000. The $6,000, if you can leave it in the account, or you can take it, best practices, transfer that money out into your personal account, pay your personal expenses from your personal account. Number 9, run a P&L statement. A P&L statement is gross income minus your expenses, cost of goods sold, equals net income or net loss. Why is that important? You want to see in categories how you generated your income, how you spent the money, did you have any left over? Okay, and if you find that you are spending more money than what you're earning, your business is screaming and telling you it's time to do something different. Just time to do something different. Not hard to do, but it gives you a tool in order for you to analyze it. Going through the expenses in the different categories. You might see, well, this month we spent a whole lot of money on supplies. Well, why did you spend a whole bunch of money on supplies? You can analyze it, because now you have numbers of what you actually did. And you can also look at your budget to see what you budgeted for and to see what happened. And then you can start to have a dialogue with yourself, or with yourself, about what can you do better, or how can you change in order to make this business profitable. Lastly, we talk about pay yourself an owner's draw. This is the money that you take from the business in your personal account to cover your monthly expenses. Next slide. Financial management software. A quick note about using financial software If you do not already use it, start it. Do not rely on paper records to keep your financial statements. There are many practical reasons to purchase and learn how to use off-the-shelf or financial management software. If you are unfamiliar with how to use it, take a course at a local community college or a business development center. This is a great way to invest in your company. I cannot stress it enough. It is an amazing way to invest in your company. I know at Crawford Management Group, we work with a lot of our entrepreneurs, encouraging them. We use QuickBooks Online and QuickBooks to basically help clients understand how to manage their businesses with the numbers. Okay. We download the bank statement into the financial statement. We teach them how to categorize the different income items. We talk to them about their business model and the things that they need to do. And we if they don't reconcile it, we reconcile it. We reconcile monthly, because what we find is things happen. And I've had a whole bunch of different scenarios over the years. Simple example, I had a client that hadn't reconciled, and this is when I first started years ago. They were paying for a copier every month and had no idea they were paying for it because no one reconciled the financial statements. They didn't have a financial tracking system, and they were paying for a copier. They were looking at the bank statements every month. I mean, they had a little bit of cash flow, but they weren't monitoring. Had paid for a copier for about, I want to say about a year and a half. $300-400 a month coming out of their account. Nobody knew. But when we started monitoring the financial statements, we were able to say, okay, well, where's this? We were identifying the assets that we were paying for. So where is this? Oh, it's not here. Okay, so let's call the company and let's find out, what's going on. So it causes you to ask questions and analyze when you're using the software, your actual financial statements. You look at your numbers and you think about, okay, so I give you another example, water bill. I'm downtown Las Vegas. My water bill normally runs maybe about $30-40 a month. One month it was $200. I'm looking at the bill, I'm looking at my financial statements, looking at prior years and what I paid during that month. And there was a broken spigot, and there were some people that were basically turning water on around my office. Well, we had to find a way to mitigate it, but it was me monitoring, looking at the bills, reading the bills, and actually making a decision right away to do something, because a $200 water bill was very high, very high. Next slide. Financial statements are reports that talk about a business's financial health and its cash flows. And if you don't learn anything else today from me, I want you to understand that when people think about their financial statements, they talk about the balance sheet and the profit and loss statement. I very seldom hear people talking about their cash flow projections. Cash flow is huge because it talks about how all of the money that is coming into your business and then the money coming out of your business and how it's flowing, right? And if you keep track of your cash flow, what you'll notice is, all right, so if I only got in, because you can have a cash injection from a loan, doesn't hit your profit and loss statement, you might see a loss, or you might not think, okay, well, I don't have any money, and that's not true. Your cash flow is a little bit different. You really, really, really want to understand how your money is flowing through your business. But we'll take the statements one by one, we'll talk about them, and we'll give you a little bit more feedback. Next slide. If you turn to pages 10 through 13 of your guide, this is a high-level overview of the balance sheet. Let me give you the equation because I don't see the equation here. Assets equals liabilities plus equity. Whatever business you're in, your assets and how we say it in the accounting world, A equals L plus E. A equals L plus E. This is very important because if you know that you have, I'm gonna give an example, okay, that we all see now. You got some of us got idle loans. That's the economic injury disaster loans. Those loans are not forgivable. They will show up in your liability section of your balance sheet. Some of us got PPP loans. PPP loans, until they are forgiven, show up in your balance sheet under liabilities, okay? Knowing where stuff goes. If you purchased a building, right? So you purchased a building and you don't know how to record this transaction. Well, when you purchased the building, that was an asset for the purchase price. This is what you paid for this building. But if you incur debt, that debt is a liability. So just being able to interpret what you did will help you understand the financial statements. Next slide. The balance sheet is also what we call a snapshot of a business at a specific point. When I was taught that the balance sheet is your camera. This is your movie, because your balance sheet is cumulative for your business. It's cumulative. So from day one to today, it tracks all the cash, all the accounts receivable, all the accounts payable, any long-term assets, any property, plant, and equipment. It tracks everything, your balance sheet. So this is an ongoing movie. Next slide. We're on cash flows. As with the balance sheet, we will quickly review the information in your participation guide about cash flows. Cash flows can be defined in two ways: balance of cash received from money paid to you over time, or moving cash in and out of your business. Now remember, cash flows, the cash flow statement, well, let me teach you. A cash flow statement is broken down into three different sections. It's cash inflows and outflows from operating, it's cash inflows and outflows from investing, and it's cash inflows and outflows from financing. Next slide. A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of a business over a future period of time. You're projecting. So a lot of times when you're reading this stuff, just think about it. You got binoculars. I see the picture. You got binoculars. You're looking forward. You're projecting, okay? A cash flow projection is used to see if projected cash receipts inflows will be sufficient to cover projected cash disbursements. A business can be profitable and still run out of cash. As an investment banker might say, cash flow projections provide a visibility needed to avoid liquidity problems. So when you hear different terms, visibility, liquidity, what does that mean? Liquidity means, are you liquid? Is the cash flowing? Or do you have the sales and cash is tied up so you can't get to the cash? In other words, a cash flow projection is a tool to help you manage your cash so you can pay your bills on a timely basis and keep the doors of your business open. Next slide. A cash flow projection is a great tool for setting sales goals and for planning for expenses to support those sales. A related use for projection is to determine your breakdown point during a startup or expansion phase. If you need to plan for large expenditures, such as equipment purchase or a move to a new location, a cash flow projection is the perfect tool. Similarly, if you have a seasonal business with large inventory purchases, a projection can help you have the cash on hand to make a large inventory investment when you need it. Cash flow projections, cash flow, part of your financial statements. Very important that you follow them all the way through. So we talked about your balance sheet. Now we're talking about how your cash is flowing. Next slide. A P&L statement can mask cash shortages if you are on the accrual method of accounting. We really didn't discuss it because there are two different methods of accounting. I want to just take a note here. Cash basis, accrual basis. Accrual basis says whenever you incur the sale, you've done the work. Whenever you've incurred the expense, it goes on your financial statements. That's what accrual says. Matching principle, accrual. Did the work in this period, that's income. You incurred the expenses period, that's an expense. Accrual basis. Cash basis. Cash basis said, I don't record the revenue until I receive the money. I don't record the expense until I pay it out. Difference between cash and accrual. That's why the accrual method can mask how cash is truly flowing. For small business owners, this is not anybody else, this is my recommendation, cash basis, so that you can monitor your business, how you're doing, how you're collecting, how you're spending money, and you can make good business decisions based off of cash in hand, okay? Next slide. A cash flow projection sample is provided for you. But let us look at the sample cash flow projection. The first set of rows is titled Sources of Cash. You document all sources of incoming cash from customers, sales, interest on loan funds, current checking account, current savings account balances. The second section is operating uses of cash. Contains all those expenditures associated with day-to-day buying and selling process. Most of these expenses show up on your P&L statement. The third section is non-operating uses of cash, shows expenses that normally show up on your balance sheet, equipment purchases, principal portion of loan payments, inventory, taxes, owner's draw. You subtract your uses of cash from your total cash available, and you have an ending cash for the month. Ending cash for one month becomes your beginning cash for the next month. Let me try to explain that a whole different way. So on the statement, you have the sources of all your money, right? Then you have the uses of all of your money. Then you have the non-operating uses. Because if you think about it, if you pay your mortgage, the money went out, but it wouldn't necessarily show up on your profit and loss statement, okay? Only a portion of it would, but cash flow, you will see the money leaving your bank account, right? On your profit and loss statement, you would only see the interest portion, and when the asset is depreciated over a period of time, you will see that as well, okay? Next slide. Review the cash flow projection spreadsheet. All right, review data in each of the cells. So to increase cash flow, the owner could increase the number of items sold, increase the price, reduce expenses, change the timing of an expense, save money so that you can have a sufficient opening cash in your startup period. So what does that mean? When you're doing a cash flow projection, you have a starting cash balance. With your starting cash balance, that's a positive number. Then you'll add in the revenue or the money that came in, money from a loan, money from sales, you'll add those funds in. Then you subtract out everything you spent money on. Once you subtract it out, okay, there's something going on with the PowerPoint. Once you subtract those funds, once you subtract those funds out, you have an ending balance. That ending balance for that month becomes the beginning balance for the next period. I won't say month, I'll say the next period. Then you start the process all over again. Beginning balance, all the cash in, all the cash out, ending balance. All right. You can do projections the same way. So the same way you're doing your budget as your projections, you can also you can also do a cash flow projections, and you can make decisions on how you believe money is going to flow. It'll also help you if you know you want to hit a certain number of clients, if you know that you want to target a certain market, if you want to rent a new space and you're looking at how much money you think you can afford in this rental space. If you want to reduce some expenses, so you want to, now you're paying $3,000 a month in rent, but you looking at your cash flow projection and what you see moving forward, you can only afford $1,000. So that might change, just your decisions. That's why we say that understanding your numbers can help you make decisions. Next slide. Next slide. P&L statement. The profit and loss statement is the best tool for knowing if your business is profitable. A P&L statement measures revenue, also called sales or income, and expenses over a month, quarter, or year. With it, you know if you have made a profit or if you have incurred a loss. The most important financial statement report is the P&L statement. The P&L statement will reflect your business decisions on basic buying and selling process. A P&L will also tell you how well you are managing your business and provide information on how to grow your business. What is the formula for the P&L statement? So we went over the formula for the balance sheet. Let's go over the formula for the P&L statement. Sales, revenue, income, all the same thing, minus your cost of goods sold. Depending on the type of business you have, that number is zero, but then cost of goods sold has its own equation. And if you have a tax professional, accountant, they can go over what that equation is. But you subtract cost of goods sold from sales and you get your gross profit. From your gross profit, you subtract out your overhead or expenses to get your net profit. Why is it important to understand these numbers? We can compare businesses by percentages, and we can tell you by looking at these numbers, creating percentages, I can look at it and tell you how well you're doing in your business. If your industry is, say, their gross profit margin is 80%, and I look at your numbers and your numbers say that you're 60%, either you're not charging enough for your products or your costs are too high, okay? We look at normally when we analyze businesses, we look at the percentages just to see how well you are doing in your business. Next slide. Gotta see where I am. Yep, got it. Yep. Next slide, because we talked about that. Side note, all of these things are very important in your business because you need to understand what these formulas are and where they are. In a future class, we'll talk about the tax return. The tax return is generated from all of this information. So as a business owner, you need to be aware of where the numbers are going. What's your balance sheet? What's your profit and loss statement? What's your cash flow projection? What's your cash flow statement? You need to be aware of this because this is you. And you want to make sure that you're telling a good story. But again, I'll go over it again. The basic formula for the profit and loss statement, sales minus cost of goods sold equals gross profit minus overhead equals net profit. Next slide. Net profit. What does net profit pay for? Net profit pays for future expansion, principal for loan payments, income taxes. I'm gonna say it again, income taxes. Net profit can pay for income taxes. I can't stress it enough. You can pay for your income taxes from your net profit. It also pays for owner draw if you are a sole proprietor. If you're a sole proprietor. Income taxes, income taxes, income taxes. I see a lot of small businesses that don't plan for the taxes, and depending on your structure will determine what the how. I mean, and we'll talk about that in the tax section. Income taxes, very important. Next slide. How do I compile a profit and loss statement? Easy if you have an accounting software, but I can caution you, you have to put good information in to get good information out. Okay, so you need just understand some basic things. So I would actually go through this course again, read through the participant guide, look at how you set things up, like because when you're setting up your accounting software, you have to set up a chart of accounts. Your chart of accounts drives your financial statements. This is a side note. So in that chart of accounts, you'll have assets. Well, we talked about that. Assets is one side of the equation, but under the assets, you might have furniture and fixtures, accounts receivable, I'm trying to think, furniture and fixtures, accounts receivable, depreciation. Very important because that's a contra asset account, accounting software. Liabilities, assets. You have long-term and short-term liability, assets. So you need to look at, to understand when you're doing something, what is it classified on your chart of accounts? Liabilities, we looked at the equation before. It's A equals L plus E. Liabilities, short-term, long-term. Okay, something under a year, short-term, something over a year, long-term. Your accounts payable is there, your notes payable is there. So if you have any long-term loans, any vehicle loans, all that stuff, liability, right? Then you have equity. So depending on your business structures will determine how your equity account is structured. Very important. Also, chart of accounts, they'll have revenue. So revenue generated goes on a profit and loss statement. Then you have expenses, profit and loss statement. Then you'll have other income, profit and loss statement, other expenses, profit and loss statement. Just knowing where that transaction goes will help to make sure that you have accurate financial statements. What I say, good information in, amazing information out. Next slide. Please invest in an accounting software. We talked about it earlier. You can take classes online, YouTube videos for almost anything if you don't understand. My name is Leah Crawford. We work with our business owners to help them when they purchase QuickBooks or QuickBooks Online. We work with them to make sure that when they're entering their transactions and downloading their bank statements, that the transactions are being classified properly so that we can get good financial statements. Review the sample P&L statement in your participation guide. What do you see? Is the business well managed? Do any problems stand out? What about growth potential? Can the business support the owner? Amazing question. Amazing question. Your personal budget says your lifestyle is $3,000 a month. That's $36,000 a year. Does the business generate enough money to support the owner? Something to think about. Will the business be able to get a loan? Again, something to think about. What is your business saying? The profit and loss statement is talking to you. A lot of times our businesses are screaming at us. I need help, please. I need help. Please stop spending so much money. Stop spending so much money. But because we don't have profit and loss statements, we don't know. We don't know. Okay, next slide. Business financing. The following items are core elements in business financing. Equity financing. Equity financings It is equity financing, invested funds that stay in the business often permanently. For most small businesses, equity comes from the owner or from a family savings and is frequently the only source of funds for startups of small businesses. For large, fast-growing quality companies, venture capital can sometimes be accessed for equity. Debt financing, borrowed funds that are paid back. The cost of debt financing is interest paid to the lender. Working capital. Working capital is used to acquire funds needed to run daily operations of the business, such as inventory and overhead expenses. Fixed asset financing, used for purchasing equipment, vehicles, and real estate. Very important that you understand the different types of the different types of financing, so you can determine which type of financing is best for you. Some people like equity. Somebody buys into your company and you might pay them stock market as equity financing. You buy stock into a company, buy a small piece, they pay you a dividend over a period of time. Debt, you purchased your house, you purchased a building, and Wells Fargo owns the debt. They have a deed, you pay them back over a period of time, and you pay them interest for using their money. Working capital, we saw that with the EIDL loans. Those were working capital loans, so that our businesses would be able to sustain over a period of time. Working capital loan. Fixed asset financing, we talked about it when you're purchasing equipment, vehicles, or real estate. It's fixed asset financing. Next slide. The do's and don'ts of small business financing. Here are some do's and don'ts. Invest your own money. You need to invest your own money first before you ask for equity or debt from other sources. Having your skin in the game shows your commitment and also shows your skill in running a successful business. Earn the right to borrow. Generally, borrowing is not a right. Rather, the ability to borrow is an earned privilege. To obtain investments, you need to demonstrate your ability to manage debt well and to run a profitable business. Show profitability. Profits are what lenders or investors want to see. Do not let lax management inhibit a healthy bottom line. Guys, work on your business. Take the time. Learn about the financing part, the finances in your business. Learn about the profit and loss statement. What does a healthy one look like? Learn about a balance sheet. What does a healthy one look like? What are healthy cash flow projections? And have you shown growth over years? You can look at your financial statements, your profit and loss statement when you have an accounting software, year over year to see if you've grown. Good information in, amazing information out. Understand and retain working capital. Experienced business owners know that working capital is critical. On the other hand, working capital is sometimes overlooked or misunderstood by new business owners. As your business grows, the amount of working capital cycling through the business to support operations should grow. Successful business owners stay aware of the working capital needed to grow and sustain their businesses. You're a business owner. This is crucial. You should know how much working capital you need. You should know how much working capital you need. Be lean on fixed assets. New business owners sometimes think they need to purchase fixed assets to start or grow a business. Fixed assets consumed precious working capital through down payments and monthly loan payments. So whenever possible, new business owners should buy as few fixed assets as possible. When acquiring fixed assets, new business owners should consider buying used or leasing the assets. Do you lease or do you buy? Do you lease or do you buy? What do you do? Cash flow, very important. And as a new business owner, you have to think about that. Do I go out and buy all this equipment? I don't even know if this business is going to work. Or do I outsource it? Might be a little bit more expensive to start, you think, But if the business is not something that you want to do in 2 or 3 years, you've got a whole bunch of equipment sitting there and you're not doing anything with it. Where if you outsource it and you charge your prices accordingly, you can be profitable, save some money, save some time. Match sources and uses of funds. When financing current assets, accounts receivable and inventory should be financed with current liabilities, line of credit, or credit card. Fixed assets should be financed with long-term loans which match the use of the life of the asset. New business owners can make the mistake of buying a fixed asset with short-term debt. Doesn't match. Forcing them to pay for an asset faster than that asset can generate profits for the loan repayment. Mismatch socks. Long-term asset, long-term loan. Short-term loan, short-term asset. But you have to understand what type of asset you're buying. Understand your financial statement. Next slide. Most types of financing requires an application process that asks for business financial statements, such as your P&L statement, balance sheet, and the cash flow projection. You want to know your financial statements well and be able to discuss them intelligently with a lender. Understand your collateral options. Most loans require assets to be pledged as security for a loan. In the event a borrower defaults on a loan, the collateral may be sold. Be prepared to discuss collateral options with your lender. Again, understand what you're doing. Have conversations about your financial statements. Understanding in a conversation. Communication. Understand risk and costs for loan types. Each type of loan carries associated risk and cost. For example, while a credit card may be easy to use, credit card financing may be a very expensive form of credit. In many cases, a small business loan guaranteed by the SBA will be a better form of loan than a credit card. No grants. There is a common mistaken belief that government grants are available for businesses. With a few rare exceptions, and we saw that during COVID, grants are not available for small business owners. Shop around. Shop around for the best loan. You may want to start where you already have personal relationships. For example, if you have a personal account at a bank, start there. Check out SBA loan guarantees available at commercial banks. Get expert advice. You can get mentoring and advice with the SBA. Do not rule out banks, especially ones with which you have a good working relationship. The FDIC has educational resources as well. Again, business financing, talked about it, relationships. You remember credit unions. Go to the credit union, talk to them. They have a lot of resources at the credit unions. At the banks, talk to your banker. A lot of resources at the bank. Talk to them about your projections, your plans, what you want to do. Hey, I want to buy a building. I want to get ready. Is there some way you can help me? You'll be shocked at what resources you'll get access to, and they'll give you some steps and help you do the work in order to achieve your goals. Next slide. Steps for getting ready for a loan. Have a business plan. Have a plan, business plan. The best way to get a loan is to have a solid plan for the use of the loan. Make sure you have a good up-to-date business plan, which incorporates a profit plan. A profit plan will show you how the loan proceeds will be used to increase sales and profitability. Showing a lender a reasonable proposition with a solid repayment plan will help as well. Your plan should include research you have undertaken to establish your cost and your marketing or sales strategies. Typically, the business plan will have a statement of purpose, list of the owners of the business, describe the business and how it will make a profit, provide financial statements like a P&L statement and a cash flow projection, and provide other documents such as references and proof of insurance. Very important to have the plan. A good business plan, you have sat down and you have analyzed and you have analyzed and you have gone through, you've looked at different stuff. And honestly, you've learned a lot about your business by doing your business plan. Know what you can afford. Using the likely loan terms, calculate the amount of funds you will need in the monthly loan payment. Your plan should include a repayment plan with projections that show your ability to make your monthly payment. Study your financial statements. As mentioned earlier, a lender will want to see your financial statements. Not only do you need to provide an accurate, current, and historical statements, you need to know what your statements say about your business. Be prepared to discuss the details of your statements and explain any issues. At my office, what we do on a monthly basis or quarterly basis or even semi-annual basis, depending on what the client asks for, we discuss the financial statements. And we have a conversation. Okay, so this month you earned X amount of revenue. What happened? This month you spent more money on payroll. What happened? And we just, inquiring minds want to know. And we just start to have a dialogue about it, talk about it. And what I've seen is our business owners appreciate the conversation. I've had some come in, I have tissue on my desk. They've come in and they cry. And I have some where we, hey, let's go out to eat because I had a good quarter. I had a good month. But we have an open dialogue so that we can talk about these statements and the importance of you understanding it so that when you have the conversation with the loan officer, we've already talked about it. We've already broken the ice. You can discuss intelligently what's going on with your business. Okay? Check your credit report. You can get a free copy of your credit report each year. Study your credit report and make sure it is accurate. Fix any inaccuracies and be prepared to explain any credit issues. Again, all of these reports, they tell your story. This is the documentation to back up your conversation. Establish collateral options. Be prepared to discuss collateral with lenders. When you are purchasing a fixed asset, the asset is often the collateral for the loan. I remember because I have one client, we have a bank loan and we've had some challenges with the building. And what the bank said to us is like, look here, we don't want your building. I know you've had some tough times. We're not in the business of real estate. We're in the business of money. How are you going to repay us? Even though it's collateral, they want to know what's your plan. What are the other options? Because they're in the business of money, especially when they loan you money. Show your equity contributions. Lenders usually require an equity contribution for a startup loan or a loan for expansion project. The required cash contribution can range from 10% to 30% of the total project cost. Again, understanding your financial statement, understanding what you're saying, where is your money coming from? You could have equity in your home. It could be a whole bunch of different things. But what is your relationship with money? What is your equity? Amazing question. Research your financing options. You will need to choose between many lenders and many types of loan. Research all of your options. Know what your options are so that you can make an informed decision about which way you want to go. Next slide. A loan package. So a loan package requires a lot of preparation, documentation. Here's a starter list, just to get you started. You need a business plan, financial statements, personal financial statement. Now, personal financial statement will show your personal assets, your personal liability, and this term we hear all the time, net worth. That's what your personal financial statements will show. And your personal and business tax returns. Now, all of this stuff goes together. If your profit and loss statement says one thing and the tax returns say something else, mismatch, doesn't match. So you want to make sure that whatever your profit and loss statement and balance sheet says on whatever basis you're working on, let's say cash basis, that's what your tax return says. And if you're having a conversation consistently You can say, well, I earned, and I'm gonna put it out there because I want us to start thinking in terms, we want large businesses. I'm $1 million business. I earned $1 million in sales. That's what my income statement says. But my tax return says my sales were only 400,000. That don't go together. So whatever your profit and loss statement says, that's what your tax return needs to say. Got it? So we want to make sure that we are consistent as business owners, because I hear people tell me all the time, well, I just gave a person my taxes and I don't know what the numbers say. It's not the right answer, especially if you're asking somebody to lend you some money. They want to know that you know. They want to know that you are astute and that you are aware of what's going on. Next slide. What are the elements of the loan package? So you have the source and amount of the equity contribution. Business loans require the business owner to contribute between 10 and 30%. We talked about that. Of the costs projected in cash or equity. Include a right of documentation. Include a right of documenting the amount and source of your equity contribution. Your credit report. Lenders will order your credit report, but it is important for you to know what they will see on the report. Please don't let it be a surprise. Please don't let it be a surprise. That's why you need to be aware so you can have a conversation. Make sure you have addressed any credit issues that are contained in the report. Collateral. Lenders usually require collateral, and they include options for collateral in your application. Purchase agreements, appraisals, contracts, and estimates. Include purchase agreements, appraisal contracts, and official estimates to document costs that pertain to your project. Again, a loan package can be very intimidating, but it can be done, and I've seen it done. And it's a lot of work. But what you're asking somebody to do is to loan you some money for something, whether it is a building, sometimes whether it's an asset, some type of asset. You're asking someone to loan you some money. Next slide. Qualifying for a loan. What do lenders look for when evaluating a loan package? A good credit score. Your credit report gives a history of how you have managed debt over the past 7 years. A good credit score tells a lender that you have the ability to manage and repay the loan. They want to see if you keep your word. If you say you're going to do something, are you going to do it? That's what your credit score says. Equity contributions. Sufficient equity contribution shows a lender that you have a commitment to the project and the ability to earn, save, and manage money. Again, you have the ability to earn, save, and manage money. Repayment ability. Lenders often analyze financial statements from the past 3 years to see if the business has the historic ability to pay debt service. A lender's criteria can vary. However, you will probably need to show that you have strong profits, good cash management skills, and growth potential. We're saying the same thing over and over again. Are you profitable? Can you manage money? Can you grow? That's what lenders are looking at. The need to show historical evidence is why it is harder for a startup business to obtain a loan. On the other hand, while most loan applications require projections, it is more difficult to qualify for a loan on projections alone. Loan to value ratio. Lenders need the loan to value ratio to be between 70 and 90% of the market value of the asset. If you are buying real estate, an appraisal will be used to determine the maximum loan amount. We call it LTV, loan to value. Put it in other terms. Something costs $100,000. The lender says they want 70% LTV. That means they will give you $70,000. You have to come up with the other 30 in order to acquire the asset. Got it? Real easy. LTV is something that a lot of real estate agents understand. But as a business owner, these are terms that we need to understand as well. Next slide. Startup financing. Here are options for financing a startup business. Equity, sweat equity, business credit card, family. Equity. Equity is simply your own money. I'm using my money in order to start this business. Many businesses are started with savings from a day job and through sale of an asset. You can launch your business by starting small and reinvesting the profits over time to build your business. That's what I did. Mine was equity. It was also sweat equity. Did everything myself. You know, owners of startup businesses are often jack of all trades. I was a jack of all trades. You put in the hours and cover the many activities of your business rather than hiring others and buying equipment. Credit cards. Very expensive, okay? Owners of startup businesses can often qualify for a credit card. When used wisely, a credit card can be a source of credit for starting small businesses. Here are some tips when using credit to use a credit card wisely. Get a separate credit card for your business use. Use only one credit card, not multiple cards. I'm gonna say that again. Use only one credit card and not multiple cards. Keep your balances modest. Keep your balances modest. Pay the balance before the due date to avoid paying interest. Do not use a credit card to prop up an unprofitable business. Remember, profits are the best way to grow your business. Lastly, family. Some business owners turn to their families for an equity contribution. My small business, I used equity and sweat equity. I used my money, did everything myself. That's how I started my business 15 years ago. 15 years later, the business now can take care of itself. Next slide. Where should you look for a business loan? You should look at banks. Many banks provide business loans, lines of credit, equipment leasing loans, and SBA guarantee loans. Start by gathering information from the bank for which you currently do business. Find out what types of business financing your bank offers. Make an appointment with your bank's lending officer to discuss products offered by the bank. If your bank is not active in small business lending, ask your accountant or other business owner in your area for referrals to other banks. Again, banks, credit unions. Very important. Look at banks, credit unions. Don't just look at the banks. Credit unions are huge, especially in the Las Vegas area. Clark County Credit Union, Clark County Credit Union, Silver State Credit Union, American First Credit Union, Navy Federal Credit Union. Credit unions are a good option for small business owners, especially if you already have a relationship. Regional lending organizations. Many are nonprofit community development organizations that have revolving loan programs for business development in their region. To locate these organizations that can refer you to lending programs in your area, search on the internet, community development financing institutions, that's CDFI. Say it again, community development financing institutions, CDFI. You can go to the Women's Development Center, you can go to SCORE, SBA, SBDC. All of these people have resources for you to find regional lending organizations. Again, whoever you decide to go to, you're going to need a business plan. You're going to have to make sure that you have all your ducks in a row, right? All your ducks in a row so that all your documents, make sure you understand your business, because don't give them a loan package that's going to be denied because you don't know what your numbers say. You have a business that has consistent losses. Nobody's loaning you any money. Nobody's loaning you any money. Okay. Go to the city and state economic development department, certified development corporation, CDCs, micro enterprise or development organizations, SBA lenders, your USDA rural development office. If you're in Pahrump, go to your USDA rural development office. See if they're able to do anything for you. And your regional SBA office. Again, guys, when you're looking for a loan, if one person tells you no, if you got a good package, you just keep on looking. But understand what package you put together. If your business and your tax returns say you've lost money over the past couple of years, they're going to look at that. How are you profitable? How you want us to lend you money and you're not making money? Just something for you to think about. Next slide. Some key points to remember. Financing is getting the money you need to start, operate, or grow your business. Start with a budget. Sound bookkeeping is the basis for all financial management. Purchase financial management software and learn how to use it. Again, purchase financial management software and learn how to use it. Again, purchase financial management software and learn how to use it. 3 statements: your balance sheet, cash flow statement, profit and loss statement. They provide a compelling story about your business. They tell your story. They tell your story. You need to learn how to read them to see if it's telling an accurate story. Separate your business and personal finances. Very important. Separate the two. Factors that affect your ability to get a loan: your credit score, your equity contribution, your repayment ability, your loan to value ratio. All these things are important. And I know it's a lot that we cover today. How do you eat an elephant? One bite at a time. I would start with getting that financial start where learning how to budget. As you're learning how to budget and then learning how to use the financial software, you're creating your financial statements. Eat this elephant one bite at a time. You are working on your business. Very important. Next slide. We have covered a lot of information. You can email me with any questions, any concerns. My email is Leah, Leaha, at Crawford, CrawfordMG.com, or you can contact our office, 702-382-5737, 702-382-5737. We go over this with our clients, especially our small business owners, on a regular basis, because we want to make sure that you're educated and that you understand. Next slide. You also want to know, be aware, what have we learned? And if we have, or you want to know what, call us anyway when you watch this video, because I want to know if you learned anything from this video. Or call Delisa, call the chamber, 702-648-6222, because I want to know if this was actually beneficial for you. You know, what is financial management? Why is financial management is important? Startup financing, growing your business, working capital, fixed assets. You know, what are the tools that you can use? What are the rules with the tools? I want to make sure that this was time well spent, that you learned something by reading this manual, going through this. This is for, you know, you could be a new business owner, you could be a seasoned business owner. I always like to go back to the basics just to make sure that I am doing the simple things to ensure that my practice can stay open, my business can stay open, and that it is taking care of me. Last slide. We have a post-evaluation that you can do. So you did an evaluation in the beginning. You can pause this and now answer those same questions and see if you learned anything. Again, I would love to hear your feedback. Our office number is 702-382-5737. Brenda and Jenny would love to hear what you have to say about my class. They encourage, I encourage them, we encourage each other to educate small business owners about what it takes to be in business. With that, I would like to give control to Urban Chamber of Commerce. Thank you guys very much for having me. I look forward to our next class. Brenda.